Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Well, we made it to the end of the week, and what a week it was. We had the Fed announcement come out. Fed announcement came out, and the market didn't like it. The market started to break down. Today, we're having a little bit of a recovery. We're up about 50 on the Dow, 100 on the NASDAQ, but this market has a lot farther to fall. Now, with that being said, we are sitting right on a support level right now. We're on the 20-week moving average. And a lot of times the market will bounce off of that. And that's where we're sitting right now. Now, even if we get a little bounce up from here, this market is going a lot lower. It's got a lot more to the downside to go. Once again, that's just my opinion. You know, really, when you look at the market, it really hasn't gone anywhere. We're in the exact spot we were 2 years ago. 2 years ago, if you went to sleep 2 years later, you'd wake up and you'd be in the exact same spot. Okay, now I think the market's going to come in. Why do I think that? Well, the HYG is the junk bonds, and the junk bonds are breaking down. They tend to make the direction of the market. If they're going down, the market's going to follow. I think the market has more to fall. But once again, we're at support, probably get a little bounce up from here. But we're in a really dangerous situation right now. Now, when I say that, I'm talking about the debt bubble, right? Right now, we're burning $1 billion an hour, almost $1 billion an hour, about 850 million every hour in debt. We're just spending money like crazy. Okay, so we got this debt bubble going, but we have this financial crisis. The banks are in a financial crisis. And did you see the bloodbath in the bond market? The bloodbath in the bond market. That is just putting pressure on the banks, putting pressure on the pension funds, putting pressure on the insurance companies. You see, the bonds that they just bought in the last couple of years have already lost about 50% of their value. There's a bloodbath going on in the bond market right now. And this is going to be a big problem for the banking system. The banking system is probably going to have a lot of banks fail. A lot of banks fail, hundreds of them. That's my take. Okay, and we also got the government shutdown coming. Now, I actually look at that as kind of a good thing. You know, they won't be able to spend as much money if they're shut down, so maybe we just leave them shut down. What do you say? Anyways, all right, let's get over to the real estate side of things. All right, so anyways, Lawrence Yun, the big chief at the NAR, he came out, he said, mortgages are going to 8%. The 30-year fixed is going to 8%. Interesting, right? All right. So, but here's the thing he says now, even though the rate's going to 8%, he says prices are going to continue to march higher. Now, he went to a different economic school than me, obviously, because as interest rates go up, prices are supposed to come down. But that hasn't happened yet, right? We took interest rates from 3% up to 7%, and the prices haven't come down. So maybe this time's different, right? Do you think this time is different? I don't. I don't think it's different. I think right now is a terrible time to be buying a house because high rates and high prices, right? But anyways, Lawrence Yun, he says that mortgage rates going to 8%. I say they're going to 10%. See, 8% will be if you have 800 credit score, you'll be able to get 8% to match your credit score, 800, 8%, right? But if you don't have an 800 credit score, I think you're going to be paying closer to 9% and maybe even 10% as we go into next year. All right, so what's happening though? Well, a lot of people, they're starting to refinance their houses. Refinancing has gone up 15% month over month, really 15%. Who are these people that are refinancing, right? Because when you refinance, you go from that 2.8% to 7.5%. Who's refinancing? This would be desperate people. A lot of people are getting into desperation mode. They don't have any money. All the money's in their house. They're house poor. The money's in the house. No money to spend, right? So they have to figure a way to tap to equity. And they're doing it by refinancing. Now, those would be very desperate people because they're giving up that 2.8 and they're willing to pay 7.5. Now, 7.5 is cheaper than putting it on their credit cards, which would be 22%. But their credit cards are probably maxed out, so they got to tap that equity. And now what's also on the rise? HELOC loans, home equity line of credit, right? Home equity line of credit market is exploding higher. Once again, people are getting desperate. They just don't have any money. What's taking all their money? Inflation, food, gas, utility bills, everything's going up. They thought they had a budget, right? When they bought their house, they thought they could make the budget work. They're not making the budget work. They're in a little bit of trouble. So they're tapping the equity with refis, tapping the equity with HELOC loans, right? But soon they're not going to be able to do this. Why? Because their house values are going to be going down. The equity is going to be getting wiped out, and that's going to put the houses onto the market for sale. It's going to be called forced selling. They can do it themselves, or they can be forced to sell in the form of a foreclosure. Notice the word foreclosure, foreclosure for selling. That's what's going to happen. A lot of inventory is going to be coming on. Now, inventory right now, heck, it's pretty low, between 500,000 and 600,000. But once you get just a couple 100,000 more homes on the market, you're going to see these prices starting to drop. I think you're going to get 1 million homes coming on the market. Why did I say that? We're going into a recession. Recession creates job losses. 10 million jobs get lost. Probably 1 million homes are going to be dumped onto the marketplace. Now, I got a question for all of you. All right. So who feels bad for these investors? All these investors that went out and they bought the house hoping to flip it higher, who feels bad for them? Do you feel bad for them? If you do, leave me a comment, right? All right, because these investors, every one out of every 4 houses that they're selling right now, they're selling at a loss. They're losing money. They're taking a big hit because their prices are going down, and they're having this, it's kind of like an oh crap moment, right? Oh crap, we got to dump these houses. Now, why do I say that? Well, you see, the thing is, these investors, they went in expecting to make money, right? Companies like BlackRock, like Blackstone, like Invitation Home, these companies go and buy thousands and thousands of homes. And they did that, right? But now they're having this oh crap moment. See, a lot of people think that when the prices come down, that these investors are going to be the ones rushing in to buy all the houses. Well, they're not going to be the ones rushing in to buy the houses. They're the ones that are going to be dumping the houses. And they're starting to dump the houses right now because they're saying, oh crap, we messed up. We made a bad decision, if you will. So I will agree that the investors have pulled the market up. They've inflated the bubble bigger, right? I mean, many areas, 1 out of every 4 homes in the last couple of years was bought by an investor. 25% of homes in many areas were bought by investors. This pulled the market up higher, created the bigger bubble. Now, these investors that pulled the market up higher have all of a sudden become a net seller. They're not net buyers, they're net seller. They're dumping their homes on the market. And these same investors that pulled the market up are going to be the ones that pull the market down. They're going to be the ones responsible for crashing the market. Now, a lot of people say, but Mike, that's not true. These investors, they're going to be waiting. They're sitting on cash ready to buy. Well, okay, I'm going to just kind of explain how this is working. And this is an exaggerated example, but it's a real example, right? I'm just going to talk about my area. Okay, so my area, you can go up and down my street, and when one comes up for sale, goes for about $2 million, you can go and you can buy that, right? Now, let's say you're an investor and you got $2 million sitting there ready to, go out and buy a home. So you go buy that home for $2 million, right? All right, so what do you do with it? Well, you could leave it vacant. A lot of investors, they don't even have their homes rented. They don't have them for sale. They're sitting vacant. That's why there's 12 to 15 million vacant properties in the United States right now. Now, where just 10% of those come onto the marketplace for sale? That'd be 1.5 million homes dumped onto the marketplace. Once again, we only have 500, 600,000 homes. You dump 1 million homes, I mean, your prices are going to really start crashing soon. But anyways, the investor, they're the ones that are going to be dumping these homes. Now, okay, so you go down my street, you buy that house for $2 million. Okay, let's say you put a renter in there, right? What's the renter going to pay you? Going to pay you $5,000 a month. $5,000 a month. All right. $2 million house, $5,000 a month. So $5,000 a month, not bad. You get $60,000 a year. But do you get $60,000 a year? No, you do not. The reason is you got to pay your property taxes. What's the property taxes on that $2 million house? About $25,000 a year. So your $60,000 $30,000 that you get to collect rents, $5,000 a month, 12 months, $60,000 you're bringing in rents, but you got to deduct property taxes. That'll bring you down to $35,000. $35,000, but you just bought the house for $2 million. $2 million. What would happen if you took that $2 million and you put it in the bank or in a bond, if you will, right? The bonds are paying, well, let's call it 5.5, right? Okay, so let's just say 5%, right? My bank's actually giving 5.5 right now. Okay, so you got these $2 million, 5%. You're bringing in $100,000, right? $100,000 a year. How much are you bringing in on the rent of that property? $35,000, and you got to worry, right? Because there's expenses. The roof could go out, the air conditioner, heater, plumbing system, something breaks. Oh, that's big expense. That $35,000 gets reduced. But you can sit on your couch and get the $100,000 without any worries at all, right? Okay, so these investors are going, oh crap, we got to rent out our houses, but we're not getting any return on our investment. We could get 5.5% return just for doing nothing. You see, the thing is, the investors should have never been in the marketplace in the first place. Corporations anyways, mom and pop, I'm all right with that. You know, you want a second home to rent out and that's your retirement, that's perfectly fine. But these corporations should have never been in the marketplace. The only reason they were in the marketplace because the Fed kept interest rates at zero. And then they can't find anywhere to make a yield on their money, right? So they get all this cash free from the Fed and they come and buy the houses, and back then houses were, 5%, but houses went up so much. They're up so much, right? My area, $2 million house, $5,000 rent, right? Okay, it doesn't work. The numbers don't work. They'd be better off collecting the $100,000 by putting it into the bank, or they get $35,000 less expenses, right? So these companies like BlackRock, Blackstone, Invitation Homes, these are publicly traded companies, right? They got to explain to their investors, to the stockholders, if you will, they got to explain to them why they're idiots. Why are you buying these houses and getting $35,000 when you could just sit on the cash and get $100,000? You see, it doesn't work. The numbers don't work. The investors are having an oh crap moment, right? They got to dump the homes onto the marketplace. They got to get rid of these as fast as they can. They're losing money. 1 out of every 4 homes that they dump onto the marketplace, they're taking a big loss. I'm not saying to feel sorry for them. This is the risk of the game, but back in 2008, who was the first ones to run out? You realize BlackRock and Blackstone, they owned thousands of houses in 2008. They dumped them then at big losses. Zillow got into the flipping game. What they do with their houses, they dumped them because it doesn't work. Doesn't make sense. Doesn't make sense for them to do it. So everybody's saying that these investors, corporations, are going to come in and save the real estate market. I don't think so. These investors are getting their butt handed to them, and they're the ones that are going to be dumping the houses that are going to bring the crash coming down. It just doesn't make sense. They're losing money, right? They're losing money because what's going up? Property taxes are going up. Insurance is going up on the house. Maintenance costs is going up on the house. HOA fees are skyrocketing. Oh, it's just a bloodbath out there. Utility bills. Now, the investor doesn't pay utilities, the renter does, but utility bills are off the chart. Everything is going up, and it doesn't make the homes profitable to rent out. So these investors that came in expecting to rent them out, and some builders also, there's builders out there right now that are building homes that aren't to be sold, they're to be rented, but what they're realizing is that this is a dumb idea. We got to dump these homes onto the marketplace, and they're going to be dumping the homes also. There's going to be a lot of homes being dumped. Now, it doesn't take very many homes to bring this market down. Look, there's only between 500 and 600,000 homes for sale right now. What if investors come and dump 1 million homes or 2 million homes? What about the Airbnb people? Airbnb's getting crushed. New York City, they outlawed it, right? You can't have an Airbnb. Well, you can't have a short-term rental, I should say. You can have an Airbnb. You just can't rent it. Okay, so anyways, they're losing too. And a lot of these Airbnb people, they got 2, 3, 5, 10 homes. 10 homes, and they're all levered out on these homes. They're losing money. Now, I'm not saying to feel sorry for these Airbnb people. They went into the game. You see those courses on YouTube channels, probably right before you watched this show today. They probably had a course on how to do do Airbnb and make $1 million so you never have to work again. You just go out and buy 5 houses and you finance them, lever them up, and just collect the daily rents. Well, you can't collect daily rents anymore. You have to rent long-term, and long-term rents don't work. The numbers don't work. The numbers for these investors are not working anymore. So they're selling, and they're selling at losses, and it's bringing the market down. We're going down. We're going down on nominal terms already. My area is down about 10% year over year. And you got to put another 8% inflation on top of that. I mean, real terms we're down about 18%. It's going to get much uglier. This is the good time. You can still get the Billy Bob price. You can get close to what Billy Bob got, but if you wait much longer, you're not going to get close to what Billy Bob got. These prices are coming down 30, 40, 50% from here. Maybe worse. Stock market's got a long ways to fall. The markets are coming in. The bonds are just a bloodbath in the bonds, putting pressure on the banks, putting pressure on the insurance company, putting pressure on the pensions. It's a bloodbath out there. Anyways, I just want to alert you to that. Don't want to depress you on a Friday right before the weekend, but I always have a tendency to do that, don't I? Anyways, get out there, everybody. Enjoy the weekend. I'm Tall Mike. Punch that subscribe button so we can talk next week, and share this with a friend. Why not? Why not? It's the weekend. Bye-bye now.